Did you know that almost 1/3 of the national debt has to be refinanced this year in 2025? If you take a look at the total national debt, we are sitting at just over $36 trillion. That is the amount of money that the government has currently borrowed. It's not the amount that it owes back, meaning it doesn't include the interest. However, that also includes treasuries that are held inside the government itself. In other words, some debt that the government owes to other branches of itself. So when you look at just the debt that the government owes to the public, you're sitting at just under $29 trillion. Well, of that, about $7 trillion of that is maturing this year, which means they have to pay that back this year. Now, if you've been paying attention at all, you know that the government never runs a surplus. For you and I, we run a surplus. When we owe money, we pay that money back from our income. If you continue growing and growing your debt, eventually you go bankrupt and people stop loaning you money, but that's different if you're the US government. They keep on borrowing more and more money and then just keep on borrowing more and more money. That's why when you look at the government's annual deficit or surplus, they have not run a surplus since 2000, which means every year they have borrowed more money than they have spent, adding to the national debt. So how in the world are they going to repay the $7 trillion that is maturing this year? Well, they are going to do it by borrowing money to do it. And yes, this is in excess of the money that they are already borrowing for their regular expenses, in excess of the taxes they're bringing in. So the $7 trillion I'm talking about here is just the amount needed to roll over the debt that's maturing in 2025. Now, it probably goes without saying, but the impact on the markets and the economy for rolling over this debt this year could be severe. It's very different than the government's rolling over its debt for the past couple of years. That's because for the last couple of years, there has been about $2.3 trillion that the government has been drawing on from the reverse repo facility at the Fed as it's been borrowing more and more money. But that is drained now, which means this cash that they're needing to borrow is not coming from excess reserves anymore because there are no more excess reserves. It's got to come from somewhere else in the economy. Now, interestingly, the fact that the government has been draining the reverse repo facility for the past couple of years has made the problem right now even worse. Number one, it's the reason why there's so much debt maturing this year, because the only reason that they were able to draw that money out of the reverse repo facility is because they were borrowing with very short-term debt. T-bills, that's debt that matures in a couple of weeks to a couple of months, anything under 1 year. And so they were looking at a short-term fix to the problem, which was, hey, there's all this cash in the reverse repo facility. Let's borrow by using bills so we can access that cash without pushing up rates everywhere else. This was a short-term fix to the problem, but it left a whopping steaming pile of dynamite on the table that is going to explode this year. In other words, all of this debt has to be rolled over again, like it did last year, only this time there's no more cash left to draw on. And by the way, guys, with Trump's inauguration just weeks away, I don't have to tell you that things could get absolutely wild in 2025. Trump's administration has already promised to cut government spending in half, issue blanket tariffs on China, even delete entire federal agencies. And while I don't want to get too political here, I can promise you this: America is about to see a tremendous amount of change. That's why on January 23rd at 7 p.m. Eastern time, I'm hosting a free asymmetric trading masterclass live on Zoom. I'm going to show you the best way I know to profit from a changing paradigm, the asymmetric trade. On this call, we're going to cover things like why I believe 2025 could be the year of the asymmetric trade, a simple 3-step protocol I have used to spot these trades, and details on a few sectors I think are poised for asymmetric trades right now. Look, in the past, these types of trades have handed out some of the biggest returns in the market, and I've personally used them to take home some big gains in my own account over the last couple of years. And now, with a massive political change about to hit the markets, these trades could present bigger opportunities than ever before. If you're interested in learning how they work, simply click on the link in the description below and enter your email to sign up. Again, attendance is completely free, but spots are limited. In fact, the last time I hosted one of these masterclasses, we had more people register for the event than I could fit on the Zoom call. So if you're interested, make sure you sign up now and I'll see you there. Now, if you take a look at this chart, this is the interest rate that the federal government has been paying on the 6-month T-bill. And you can see that recently this rate has been falling. And that's simply because the Federal Reserve has been lowering interest rates. Contrary to popular belief, the Federal Reserve doesn't outright control interest rates. They don't control your mortgage rate, your auto loan rates, your credit card rates. They only control the Fed funds rate, which is basically the amount that banks get paid to lend and borrow from each other overnight, hold reserves at the Fed. So that influences other interest rates across the market, but mostly it's going to influence interest rates that are closest to overnight rates, which means short-term rates like T-bills are going to be affected, but long-term rates on something like the 10-year bond are not going to be affected, which is why you've seen the 10-year yield rise so steeply ever since the Fed started cutting. If none of that makes any sense, just picture it like this. When the Fed lowers short-term rates, that makes it easy for the government to borrow printed money. This expands the money supply as they spend that money into the economy, driving up prices, which means lenders for real debt, like mortgages or auto loans or credit cards, business loans, are going to want to be compensated for that inflation, and they're going to demand a higher interest rate. In other words, as the Federal Reserve cuts rates and the government gets to borrow at the short-term end of the curve for cheaper and cheaper, everybody else pays a higher and higher interest rate on their debt because of inflation. The other problem is that a big chunk of the US national debt now is in T-bills. It's in very short-term debt, which means if the Federal Reserve suddenly has to fight a resurgence of inflation, if inflation hits 5–10% just really quickly for unknown reasons, then the US government is in a really, really bad position because suddenly they're rolling over debt that they were expecting to be able to roll over at a lower interest rate, but they're rolling it over at a much higher interest rate. Now, the incoming Treasury Secretary Scott Bennett has been very clear that he wants to get back to a normal distribution of debt across the yield curve. Yes, he wants to have some T-bills, but we've got way too much in short-term T-bills right now. He wants to roll a lot of that over into longer-term debt. 10, 20, 30-year debt. Now, on the surface, that does sound like a decent idea, but there are some big problems, especially with its impact on markets and the economy. Number one, consider that that is a lot of borrowing the government is going to have to do. And even with the small borrowing it's been doing at the longer end of the curve with the 10-year and the 20-year recently, it has already started to push interest rates higher, which means that if there's any significant amount that the Treasury decides to roll over these T-bills into longer-term debt, like 10 or 20 or 30-year, that's going to push interest rates up a lot. There's just not enough cash in the system right now for there to be enough demand for that kind of debt at current interest rates. It's very possible that during 2025, we could see the 10-year interest rate go to 5, 5.5, 6%. Now let's imagine what kind of impact that will have on the stock market. To put this into perspective, let's say you could loan money to the government for 30 years and get a guaranteed 20%. How much of your money would you loan to the government and how much of your money would you keep in the stock market? Well, given the fact that the stock market has returned 10% on average, most people are likely to decide, I'll get the guaranteed 20% from the government instead, which means that would suck all liquidity out of all productive enterprise, all private sector lending, all risk assets like the stock market. All of that would be sold off and go to be loaned to the US government. The more borrowing, and especially the higher rates the government pays, the more it sucks capital away from the productive economy. Now, that's an extreme example, but now you get the point. When the government has to start paying higher and higher interest rates on its long-term debt, it does indeed suck cash away from public markets and private enterprise. In other words, institutions will buy up long-term government bonds, like 10-year treasuries, instead of investing it in risk assets like the S&P 500, and especially instead of investing it in private bonds and lending it to these companies for productive purposes. Now, it's not binary, it's a spectrum, but the more the US government tries to do the smart thing by rolling out those T-bills into longer term debt, the more that will impact markets and the economy, at least short term, for the negative. Now, I am not making the case that this is going to crash the stock market, unless this is done in an extreme fashion, without any regard to the impact on the market or the economy. I think it is very likely the market continues to march on higher. But in my opinion, the most likely scenario over 2025 is extreme bouts of volatility. Markets moving erratically in one direction or another, big differences in performance from one asset class to another, spikes in volatility, flash crashes, you name it. In other words, the perfect storm for somebody who's trying to make money actively in the markets. And if you'd like to join me, don't forget to sign up for my asymmetric trading masterclass. Link is in the description below. As always, thank you so much for watching. Have a great day.